Well, there's been a lot of talk lately about the United States drifting toward a direct clash with Iran and how that could light a fuse under oil, gold, and especially silver. So, in this video, we're going to separate what's real from what's noise, and you're going to walk away sharper and more prepared for whatever the weekend brings. Today is Friday, February 20th. And the range matters because the market can front or run a range for days and then reverse in minutes when the outcome shifts. Here's the part that retail traders consistently miss. The loudest headlines are not always the most actionable ones. Sometimes the headline is the bait and the actual market move is what happens when that headline gets walked back, rewarded, softened, delayed, or reinterpreted by a spokesperson. If you've traded geopolitical risk for any length of time, you've seen the loop. Tension rises, prices pop, then a single sentence like productive talks hits the tape and everything dumps for a few hours. Then the next day, a different sentence like still far apart brings the risk premium right back. That whiplash isn't a glitch, that is the trade. So here's a quick mental tool that helps. Whenever you see a headline, ask two questions. What actually changed? And what is just the same story being told with different words? Because markets don't react to the story. Markets react to the change in the story. And the best clue is not your opinion, it's the price response. If a scary headline hits and the market barely moves, that usually means positioning was already leaning that way. If a mild headline hits and the market moves like it got punched, that usually means positioning was offside. That's why I always say trade the reaction, not the narration. Now, the second mental tool is about weekends. A lot of people think markets close on the weekend and therefore nothing matters. But futures don't really sleep, and liquidity can get thin at the exact moment everyone is staring at the same breaking news banner. So you can get these sudden air pockets, not because the world changed more, because there weren't enough bids sitting there when the first wave of orders hit. That's also why you'll sometimes see a big move Sunday night and then a partial reversal by Monday afternoon. The first move is panic pricing. The second move is people realizing, okay, now we can actually trade this like adults. So if you're carrying exposure into a weekend like this, it's not about being brave. It's about being honest with yourself about gap risk. And if you're not comfortable with a gap, you're not positioned for the environment you're in. Okay, back to the main thread. So I want you to hold two ideas at the same time. One, the risk is not imaginary. There are real talks happening, real red lines, real military movements, and real reporting describing a heightened posture. Two, the timing is not guaranteed, and anyone telling you it's guaranteed is selling you certainty, not giving you an edge. Now, there's another layer people are skipping. Even if action does happen, the shape of it matters more than the word action. A limited strike, a broader campaign, and a drawn-out standoff can all be called escalation, but they don't price the same. A limited strike might spike oil briefly, push gold higher, and then fade if the shipping lanes keep moving. A broader campaign might keep risk premium elevated and pull in second-order trades because it drags uncertainty out over weeks. And a drawn-out standoff can be the weirdest one because it can keep markets tense without delivering the cathartic headline that resolves anything. So instead of predicting which one will happen, let's talk about what the market can actually tell us. Let's talk about silver. The setup that keeps getting mentioned is basically this. Silver took a hard hit. Then it spent weeks moving sideways to down in a tight range. And now it's pressing up under an obvious ceiling. That description is fair. It's a coil. It's a spring. And if you've watched silver for years, you know what it likes to do when it stops being boring. It likes to be violently not boring. But here's where I want to slow you down for a second, because this is where the story can get sloppy. People look at a pattern and they treat it like a promise. But patterns are not promises. Patterns are conditional. It's a flag. Therefore, it must break up. It's a flag. So if it breaks up and holds, then the next move can accelerate. And the holds part is the whole game, because silver is famous for the move that looks like a breakout, right? Until it isn't. So what would make it real? Not a random wick, not a 10-minute spike on a scary headline, a clean push through that overhead line, and then the next push that doesn't immediately get slapped back down. That's the market telling you buyers are absorbing supply, not just reacting to a rumor. Now, you'll hear people tossing out moonshot targets the second that line gives way. Could silver sprint? Sure. Silver can travel fast when it's moving. But I want you to think about the difference between possible and probable, and the difference between probable and already priced. If silver has been bid as a crisis hedge, then part of that move is already in the cake. The bigger move comes when the market realizes the cake is bigger than it thought, and that realization usually needs either follow-through or escalation. Now, here's a piece of fresh context that matters for silver specifically. Silver isn't just a fear trade, it's also an industrial metal. When investors are nervous, they buy it because it's monetary. When industry is expanding, it gets pulled because it's useful. And lately, public industry updates have been pointing to continued structural tightness in the silver market, meaning demand has been running ahead of supply for multiple years, and investment interest has stayed stubbornly strong. That doesn't mean price only goes up. It means the floor can get more stubborn over time. And when catalysts hit, the market doesn't have a lot of slack to absorb them. So if you're wondering why silver keeps acting like a compressed spring, that's one reason. But let's not pretend silver moves in a straight line. It never has. It does this thing where it makes you impatient, then it makes you reckless, then it punishes both. So if you're going to play it, you need rules. Now the next claim is that the miners are leading. Sometimes that's true. Mining shares can act like a leveraged bet on the metal, so they sniff momentum early. And yes, there have been signs of the junior miner basket acting a little more eager than the spot price. But here's the caution. Miners are also equities. They don't just trade on metal price, they trade on risk appetite, liquidity, funding conditions, and broad market stress. So, in a real geopolitical shock, where the stock market sells off hard, miners can get dragged down, even if metals go up. It's a weird paradox, but it happens. And there's another twist people forget. If oil is ripping higher, costs rise too. Diesel matters, power matters, transport matters. So even if the metal price is supportive, a sudden energy shock can squeeze miners' margins at the same time. That doesn't kill the thesis, but it changes the timing. So if you're watching miners as your leading indicator, make sure you're also watching the broader tape. Is the market in risk on with metals up mode, or is it in everything gets sold for cash mode? Because in that second mode, your leading indicator can suddenly become your warning sign. Okay, now we have to talk about oil, because oil is the accelerant in this whole story. If there's one asset that tends to move first and move loudest in a Middle East scare, it's crude. And lately, crude has not been acting sleepy. There's been a burst higher, and it's lined up with the headlines getting hotter. Now, I'm not going to sit here and tell you the chart can predict war. That's a fantasy. But the chart can tell you when traders are willing to pay up for insurance. That's what a risk premium is. It's not the world ended. It's the market is willing to pay extra in case the world gets uglier. And based on recent market updates, that premium has been building. So the real question isn't will oil spike? The real question is, what happens if the choke point story becomes more than a story? Because the Strait of Hormuz is not a normal headline. It's a lever. It's a narrow funnel that a huge amount of energy trade has to pass through. And according to the latest publicly available energy data, flows through that strait makeup about a fifth of global oil and petroleum consumption, and more than a quarter of global seaborne oil trade. On the gas side, it's also around a fifth of global liquefied natural gas trade. And here's the part that makes it uncomfortable. Even with pipelines and alternative routes, only a limited slice of those volumes can realistically bypass that waterway on short notice. So when Hormuz's risk enters the chat, it's not just fear, it's math. And let me clear up a stat that gets repeated in a really confusing way. You'll hear people say, Hormuz is 30% of the world's oil. And then someone else says, no, it's closer to 20%. And it turns into this pointless argument like we're debating the height of a mountain. Here's what's going on. There are different yardsticks. One yardstick is global consumption. Another yardstick is global seaborne trade. Those are not the same thing. A barrel that gets produced and consumed domestically never touches a ship, so it doesn't show up in the seaborne share. And a barrel that does move on ships can represent a bigger share of trade than it does of total consumption. That's why you can see around a fifth in one context and closer to a third in another context. And both can be accurate, depending on the lens you're using. The practical takeaway is simple. Even if you don't memorize the percentages, you should understand the asymmetry. A disruption at a choke point doesn't need to remove all supply to move price. It just needs to threaten the marginal barrel. Because oil prices are set on the margin, not on the average. And the marginal barrel is the one that traders suddenly don't feel confident can get delivered on time at a predictable cost. Now, historically, you don't even need an actual closure to get that effect. Remember, markets have reacted in the past to tanker incidents, drone attacks on infrastructure, and even aggressive rhetoric because the insurance market reprices risk before the physical flows fully change. That insurance repricing then becomes a cost repricing, and then that cost repricing bleeds into inflation expectations. So when you hear Hormuz, don't picture a gate slamming shut. Picture a toll booth where the toll can triple overnight and nobody can tell you when it goes back down. That's the kind of uncertainty markets hate. Okay, back to metals for a second, because there's a psychological trap right here. When gold moves, people nod. When silver moves, people get emotional. And that's because silver is a smaller, thinner, more reflexive market. It doesn't take as much capital to move it, and it tends to overshoot both directions. So if you're a long-term holder, silver is the thing that tests your patience. And if you're a short-term trader, silver is the thing that tests your discipline because it can give you the exact move you wanted and then take it away before you even blink. That's why when people throw out aggressive targets, I always remind you silver doesn't travel in a straight line. It travels in bursts. So the question isn't, can it get there? The question is, can you stay sane on the way there? Now, here's another fresh angle that ties back into silver's industrial side. If you get a serious energy shock, it can be both inflationary and growth negative. That combination is awkward. It can push investors toward hard assets, but it can also hit industrial demand. So silver can sometimes get pulled in two directions at once. Gold tends to be cleaner in that environment. Silver is more like a tug-of war. That's why the confirmation matters so much. You want to see the market choose a direction, not just spike on emotion. Okay, now let's zoom out to the big macro consequence, because this is the part that can outlast the headlines. Even a limited conflict risk forces governments to spend. It forces governments to posture. It can force governments to subsidize energy or stabilize domestic prices. And all of that historically tends to mean more debt, more borrowing, and more political pressure on central banks. So when you hear people say war is bullish for metals, the better way to understand it is it's not the war itself. It's the policy response to the war. It's the financialization of the shock. It's the way a real-world problem gets converted into a balance sheet problem. And balance sheet problems are where gold and silver tend to re-enter the conversation. Okay, now why do markets flinch? Not because the strait is guaranteed to close, but because you don't need a full closure to get a price shock. You just need uncertainty. You need higher insurance costs. You need ships hesitating. You need reroutes. You need one incident that makes every risk manager in the world tighten the screws. And when that happens, oil doesn't just move because supply is gone. Oil moves because fear is now part of the price. Now here's the skeptical angle, because this is where people oversimplify. A lot of talk treats Hormuz like it's a binary switch, open or shut. Reality is messier. Even during tense periods, shipping often continues. Sometimes with added naval presence, sometimes with altered patterns, sometimes with elevated costs. But it continues, and that's why you'll often see oil surge and then fade, because the market realizes the worst case scenario wasn't immediate. So if you're going to position around Hormuz risk, you have to accept that you're trading a probability cloud, not a certainty brick. And you also have to respect that the market can price fear faster than you can refresh your feed. Now, there's another thing I want you to watch, and it's subtle. Watch how oil reacts to good news. When fear is dominant, good news barely moves the market. When fear is fading, good news causes sharp drops. That reaction tells you whether the premium is sticky or fragile. Okay, let's bring gold into this, because gold is the adult in the room. When gold starts moving, it's usually telling you something bigger than a single trade. And we've seen gold respond when the rhetoric heats up with coverage describing safe haven demand during the latest flare-ups. But here's the tricky part. Gold can move for opposite reasons in the same week. It can rise because fear rises. Then it can dip because the dollar rises. Then it can rise again because yields fall. Then it can dip because someone says talks are going well. So if you're watching gold, don't just watch the price. Watch what else is moving with it. Is the dollar climbing? Are stocks falling? Are real rates rising? Or is gold rising in a world where everything else is rising too? Those are different signals. Now, I promised a third story, and this is the part most people skip. The second order trade. Here's the simple version. When energy reprices, it doesn't stop at the gas pump. Energy is an input into everything. And there's one industry where that's almost painfully literal: nitrogen fertilizer. Natural gas isn't just a fuel in that supply chain. It's part of the recipe. So when natural gas prices surge, especially in Europe, fertilizer costs can surge with it and production can get squeezed. We saw that dynamic during the Europe energy shock when high gas prices hit ammonia production, which is a key building block for nitrogen fertilizer. And by the way, that period wasn't just painful for consumers, it was wildly profitable for certain producers. Some industry analysis showed fertilizer giants posting profit margins north of a third during that spike era. That's not because they're magicians. It's because when supply is constrained and the input costs diverge region to region, pricing power concentrates. Now connect the dots. If Hormuz's risk pushes up global energy prices, that can bleed into gas pricing, shipping costs, and industrial inputs. It doesn't have to be perfect. It just has to be disruptive enough to change margins. And that's why some traders have been watching a big North American fertilizer name. One ticker people point to is spelled NTR, because if Europe gets squeezed again, producers with cheaper feedstock and better logistics can look relatively advantaged. That is the logic. But let's stress test it, because we're not here to swallow a thesis whole. The bullish version says, higher global gas, higher fertilizer prices, domestic producers win. The skeptical version says, if the shock is severe, the whole economy slows. Farm demand gets pinched, and governments intervene with policy, subsidies, exports, and emergency measures. And on top of that, companies aren't just passive. They hedge, they lock contracts, they manage inputs. So the energy spikes. Therefore, this stock moons chain is not guaranteed. It's a possibility, a scenario. So if you like this kind of second-order thinking, do this with me. Instead of betting the whole story, build a watch list and watch the spreads. Watch European gas versus US gas. Watch fertilizer benchmarks versus crop prices. Watch shipping and insurance chatter, because those relationships tell you whether the thesis is actually turning into reality. Now, let's zoom back out, because I want to add one more piece of fresh context that matters a lot right now. And it's not coming from any chart, it's coming from policy. Based on recently published updates, the market has been rethinking how quickly rate cuts might come because inflation progress has been uneven, and the labor market has stayed tighter than a lot of people expected. Why does that matter for this story? Because energy spikes are inflation spikes, and inflation spikes change what central banks can do. So if oil gets another leg higher on geopolitical risk, that doesn't just hit your portfolio, it hits expectations, it hits yields, it hits the dollar, it changes the discount rate for everything. This is why I keep saying the story is not just buy metals. The story is the web of second and third order effects. Now, I want to pause and ask you something because I think it matters. Do you think the market is already pricing in the worst case scenario here, or do you think it's still in denial? Drop your take in the comments and tell me what you're watching as your personal tell. And here's a second question. If there is an escalation, what do you think moves first? Oil, silver, or the dollar? I'm curious because I've seen smart people argue all three. Okay, let's address one more point that keeps popping up. The buildup proves it. Yes, there's been discussion of increased assets in the region, including carrier movement, and that's real reporting. But military posture is not a binary signal either. Sometimes it's preparation for action, sometimes it's deterrence, sometimes it's a negotiating tool, and sometimes it's a way to create optionality so a leader can choose from multiple paths. That's why, even with serious posture changes, the diplomatic lane can still remain open right up until it doesn't. And we know diplomacy hasn't fully closed because indirect talks have been happening and are being mediated with officials on both sides, acknowledging small steps but big gaps. So, if you're trying to trade this, do not anchor yourself emotionally to the most dramatic interpretation. Anchor yourself to the practical question. What would change the market's expectations from where they are right now? Because that's the real catalyst. Not war as a word, but surprise as a reality. Now let's bring it back to the chart setups because that's where people either get disciplined or they get reckless. If silver is pressing into resistance, you do not need to predict geopolitics to manage that. You can say, if it breaks and holds, I respect it. If it fails and dumps, I respect that too. That's trading. If the minor basket is popped early, you can say if it holds above the breakout area while the broader market is steady, that's strength. But if it pops and then rolls over as equities weaken, that's not leadership. That's a head fake. And for oil, the simplest framework is this. There's a baseline supply-demand story, and then there's a fear premium sitting on top of it. When fear rises, the premium expands. When fear cools, the premium contracts. So the trade is not oil to the moon. The trade is fear expanding or contracting. Now, from the last couple of sessions, fear has been expanding, but that can change fast, especially on weekends when headlines hit and there's no immediate liquidity to absorb them. And that weekend dynamic is one of the reasons people keep talking about weekend operations in the first place. Not because it's guaranteed, because it's when the market can't instantly price it. Now, one more thing, and I'm going to say this gently but firmly. If you find yourself rooting for a crisis because it validates your position, you're doing it wrong. It's normal to want to be right, but being right in a crisis can still feel awful because the real-world costs are real. So the healthier mindset is, I hope none of this escalates, and I also refuse to be financially blindsided if it does. That's not cynical. That's responsible. And by the way, if you're successful, share your success story in the comments so others can stay motivated. Now, what am I watching specifically over the next couple of days? I'm watching the language around the negotiation window. Whether it tightens or loosens, whether the tone hardens or softens, I'm watching whether the market treats progress headlines as real or treats them as temporary smoke. I'm watching oil, not just for direction, but for speed. If oil creeps, that's one regime. If oil gaps, that's another regime. I'm watching whether the dollar strengthens at the same time as oil, because that tells you the market is moving into a stress posture. I'm watching silver's overhead line. If it breaks and holds, the path opens up for a run toward a higher psychological zone than most people expect. If it rejects hard, then the coil keeps coiling and patience wins. I'm watching miners relative to the broad index. If miners are strong while stocks are weak, that's interesting. If miners are weak while stocks are weak, that's just beta. And finally, I'm watching the second order chain. If you see European energy benchmarks jumping while US benchmarks lag, that's the kind of divergence that can make the fertilizer story start to matter again, because the story is not fertilizer is exciting. The story is energy shocks don't stay in their lane, and the market loves to discover that late. Now let me close with this. A lot of people want a simple answer. Buy this, sell that, target this number. This. But the reality is, the next few days are about probabilities and reactions. And the biggest edge you can have is not predicting the headline. It's being ready for the market's response to the headline. So subscribe if you haven't, because I'll keep breaking this down as the situation develops. And I'll keep it practical and grounded. And remember, none of this is a guarantee. It's a map of risks and a map of possible market behaviors. Use it to think clearly, not to panic. All right, that's it for today. Stay safe out there, and I'll see you in the next one. And just to be crystal clear, this is educational content based on publicly available information and general market history. I'm not your financial advisor. I don't know your situation, and nothing here is a recommendation to buy or sell anything. Make your own decisions.